Please welcome to the stage Anil Dash, MC for Mozilla Festival 2025.
Good afternoon, everybody. How are we doing? All right, good to see you. So, all of you will have been engaged in all that we've been doing here at the Mozilla Festival, and you will know that one of the things Mozilla is committed to is accessibility. So I want to remind those of you who might not have been here yesterday that we do have simultaneous translation happening to sign language from English to Catalan Sign Language, and then from Catalan Sign Language to International Sign Language. So we can thank our translators who've been here diligently all day yesterday and today. Thank you for being here. All right, and what we're going to do is we're going to jump back into the debates that have been animating the conversation yesterday and today. This is one I am extraordinarily excited about. We are going to be in one of the hardest conversations, I think one of the trickiest topics, and that is growth. We're going to talk about unlearning growth, right? Because growth is vital, right? It is essential for digital ecosystems. It is something we need for business opportunities, for the things that we want to create. But it's also one of those things that drives surveillance. Sometimes it can even drive exploitation. So we're going to need some really, really deeply insightful people to help us understand what's happening with growth in this conversation. And I will tell you, you are extremely fortunate to be able to hear these voices on these. These are two of the people I trust personally most as sounding boards on these topics. So you're going to be listening to Peter Rojas from the Mozilla Corporation and Catherine Bracey from Tech Equity. And they're going to be moderated by Harry Booth from Time. So please welcome our moderators and our debaters to the stage to talk about unlearning growth. Welcome.
Welcome, everyone. Be honest with me, raise your hand if you're hitting your afternoon slump right now. Yeah, I see a few hands. Maybe I'm a little guilty too. Well, you can sit back and relax and maybe treat this like a podcast. But we will have time for your questions at the end, so just keep that in mind. Don't zone out too much. You've probably heard a lot about unlearning over the past 2 days. Re-examining the assumptions that for too long have gone unchallenged and unquestioned. Today, Peter and Catherine are going to be taking on a concept that arguably not just underpins the tech industry, but really underpins our entire economic system. And I'm talking about growth, so yeah, no pressure to both of you. Peter, I want to start with you. When we talk about unlearning growth, what specifically needs to be unlearned? Is it growth itself or the way that it's traditionally been defined?
Yeah, I mean, I'd say that, and I want to thank both of you for what I think will be a really great conversation today. You know, I'm not anti-growth. Right? I think that if anything, the products and businesses that I'm trying to build at Mozilla Corporation, we're trying to grow them. And the way in which I think about growth is that we want to create products that people value and find value in. And part of how we define value is through our mission and the promises that we make about the things that we're going to build and that we're going to offer. And so I think that when we talk about growing products or growing businesses, we want to make sure that we're doing them in a way that first doesn't create unnecessary harms, right? Negative externalities, whether that's a factory making pollution or it is a digital, an app which is creating, capturing data, which is then being shared, with possible negative implications that the users might not be aware of, right? If your personal data is being collected and being shared in ways that you are not consenting to or authorizing, there can be real harms to that. And we've seen examples of apps which are, even well-intentioned, being careless about how they're collecting user data and then sharing that, and then people not just being retargeted for ads, for example, but actually people's private personal data being exposed in ways that compromises their safety. And so we can think about all sorts of ways in which the drive to just capture user growth or profits can lead to making product decisions which end up leaving either individuals worse off or us as a society collectively worse off.
Catherine, I want to throw it to you. You've also said you're not a degrowther, but that we need to unlearn a certain approach to growth. So tell me about that.
Yeah, I mean, I totally agree with Peter, which is going to make for not quite a great debate. Apologies for setting that expectation for everybody. Yeah, I mean, growth can be benign or malignant. You know, I mean, I think when we think about this in the context of biology, you know, our hair grows and that's a good thing. Kids grow up, that's a good thing. But you know, if you have a tumor, that's probably not a good thing. And I think really being able to distinguish between whether this growth is, you know, for what end, whether it's a good end or not, is a really important part of the conversation. And I think being sort of anti-growth, full stop, you know, can prevent good things coming to market as well. So I think we need to develop a little bit more nuance about how we think about what is good growth and what is bad growth. And from where I sit, I mean, I think what Peter pointed out is really the crux of the issue. What are the values that are determining the design and product development decisions that are being made? And, you know, I guess we'll get into this, but from where I sit, I think the problem in tech now is that the value system that is determining the direction in which the technology is growing has been corrupted. The logic of venture capital is now, I think, malignant and causing technology to grow in a malignant way. And you know, the sort of mindset of product development that we need to be careful to think about, like, what are we growing towards? Why are we building this? Is just few and far between.
Well, I guess that question of growth to what end? I mean, Peter, part of Mozilla's structure is designed to let you both pursue revenue, but also remain mission aligned. Can you just at a high level kind of explain what's going on over at Mozilla?
Yeah, so for those who aren't entirely familiar with Mozilla Corporation, it is a company that's owned by the broader Mozilla nonprofit, mozilla.org. And you know, it's where Firefox is housed, and it is a business which generates revenue. And we generate revenue in part to support the development of Firefox and other products, but also to generate profits which can be used by the nonprofit for its advocacy and other work, right? And so, you know, for us, we don't have shareholders to answer to. We don't have, you know, sort of quarterly objectives in terms of hitting specific numbers in terms of growth. But we also need to be sort of competitive, so to speak, in the broader market and make something that people do want to use and that can generate revenue, right? Like, there isn't a nonprofit exception to, you know, how the market works, so to speak. Where, you know, our advantage comes into play is that we are able to take a longer time horizon, and we're able to prioritize and center users in ways that a more profit-centered, you know, business might not. Now, I don't want to say that every, you know, profit-oriented corporation doesn't have values or they don't center users, because there's plenty of examples that you can point to. But with us specifically, it's in our charter. It's part of our mission. We have a set of values that we aren't going to compromise ever in the way that we build our products.
So you joined Mozilla Corporation earlier this year. I mean, how does that sort of having your values, having a charter, cash out in the company culture to, say, your previous employer, Meta?
Mm-hmm. Well, I mean, Meta obviously has a reputation for being extremely profit-oriented, right? And I can give you examples of when at Meta we actually didn't entirely just focus on capturing profit. So it's you know, even at a place like Meta, for example, I spent my last year there working on Messenger, the messaging product, and oftentimes people would propose a new feature that would increase usage or user growth, and it would be rejected by leadership at Messenger to say it's too growth hacky. It's actually going to compromise something about the user experience that we value and we don't want to sacrifice in order just to move the number up a little bit. Now, I'm not going to say that, in general, the pressure is very strong to move those numbers up, to generate revenue, to increase DAU and other metrics and engagement metrics. But even at a place like Meta, there are lines that they wouldn't cross. Some of those lines were ones that enshrined in sort of the company values. Others were ones that were imposed from without in terms of like consent decrees with the U.S. government in terms of things you can't do. But I think that rather than viewing the mission that we have at Mozilla as a constraint, or it tells us all these things we can't do, I really take the perspective of every company has, like I said, they have values. They may have poor values, but they do have decisions that guide how they make what they decide they want to do. But the mission really, for me, helps frame how are we going to deliver value for the people that use our products, right? And how are we gonna, and by extension, how do we make sure that we are having a positive impact on the internet and on the world? And so, it ends up actually helping you think through how you want to build products, like what directions you want to take things. So it hasn't been a negative constraint in the ways that it might seem from the outside.
I mean, you mentioned about needing to compete in the marketplace. Let's take Firefox, for example. Mm-hmm. We're at Mozilla Fest. It feels like everyone here uses Firefox.
Yeah.
But if you look at the market share as a whole, Firefox has maybe 2%, Google Chrome has like 73%. Is there a risk that just focusing on your values and your mission means that you get outcompeted in the market?
I mean, it's definitely a challenge, right? And I think that when we think about what we want to do next, and we're building an enterprise version of Firefox, which we just announced this week, and you can, and part of the way that we're looking at that is that we have to compete with every other enterprise browser out there. So that does mean that we have to, be at feature parity in terms of like what we offer, but we actually think our ability to offer our trusted brand, to be open source, with not every aspect of Firefox Enterprise, but with most of it, and also to be transparent in the way that we operate, is actually a selling point when we're competing in the market. So again, I think that the way that we have to approach this is to not look at it as a constraint, but to really say, how can we lean into the ways in which we differentiate? Now, look, most people are not picking their technology products for ideological reasons. I wish that were the case, but it's not. They're not politically motivated in this. Very few people are politically motivated in those ways, or are even thinking about privacy in the same extent that we do in terms of privacy. But we know that when we are able to build a high-quality product that offers features and functionality that customers are looking for, that we can often get them to make those choices and to go with our products. Now, Firefox, it's definitely like a long road back to growth, but you can see how even like the dynamics of the browser market are changing in real time right now with AI browsers, for example. And so suddenly a category which seemed very moribund and maybe kind of stale is now reanimated. And it's actually, I think, creating an opportunity for us to say, this is great, but again, we want to make sure that if you are integrating AI into the browser, that we're thinking about safety, we're thinking about transparency, we're thinking about privacy, because there's a really great report about how some of these other AI browsers are massive security risks, right. And they can leak your private data. They can be taking actions on your behalf that you don't intend. And so our approach, which is a little more cautious and thoughtful, is actually centering the user, and I think in the long run means that we will be a more trusted choice for those kinds of products.
I mean, Catherine, what do you make of this general argument that mission-driven models are just inherently less competitive and therefore are going to get outcompeted?
I mean, I think there's something to it. I think I just spent the last several months trying to push back on OpenAI's attempt to restructure from a nonprofit to a for-profit. And Mozilla was kind of held up as an example of what they were trying to do. And I kept saying in every meeting with the Attorney General and, OpenAI themselves, like, no, there's a huge difference between you and Mozilla, and that's that, Mozilla doesn't have any shareholders in the for-profit. The nonprofit is the only owner of Mozilla, the company. You, OpenAI, have sold off equity stakes in the company to, venture capital investors who are now determining the outcome of the company and are driving the design decisions and all of this. So, their logic and the logic of, the venture capitalists that now control OpenAI and have really succeeded in making sure that the nonprofit is actually subservient to the for-profit, is that they have to take as much market share as they can as quickly as possible. And even for nonprofit, your question is sort of making the point that, like, even if you don't take venture capital, that logic affects how you make decisions because you have to compete with people who are. So I think this idea of, kind of opting out of the system as it is, and then you'll be able to grow something. I mean, it's great. You should live your values, and I think it's really impressive how Mozilla has been able to really make a going concern of prioritizing user safety and privacy. But ultimately, we are going to need government to set the context, like set a floor on which everyone is competing. And there's no, I guess, no surprise that companies who are venture-backed push back really hard on any of those guardrails that would make them have to compete more on the merits than just on, pure growth.
I want to take a step back real quick. Venture capital, VC, venture-backed. I mean, you've written the book on this, World Eaters.
The book, that's a lot of pressure.
Just in case, not all of us are VC experts, Can you just tell us really quickly what venture capital is and how you see it shaping the incentive structure that surrounds a lot of the technology industry?
Yeah, I mean, I think a little bit of history will help.
Sure.
I mean, VC was solving a real problem when it was kind of pioneered in the middle of the 20th century, and that was that there wasn't enough risk capital in the financial system to bring new technologies to market and see if they had commercial applications. And a group of sort of civic and business leaders got together to think through how they could attract investors to invest in these startups that had no track record, and it wasn't even clear if the technology could be commercialized. And what they landed on was a portfolio structure, and I think we all kind of understand venture capitalists to be investing in sort of a portfolio approach. That was not always the obvious solution, where you would group companies together and spread the money around so that you were also distributing the risk. And the idea was, since there was so much upside potential in these risky startups, that the winners would be huge winners and more than make up for the many larger number of losers or smaller outcomes. And that worked. And it wasn't obvious that it would work at the time, but it was tried and they succeeded. And I think, and that distribution is called the power law, and that's sort of the law that rules Silicon Valley now. I think venture capital in many ways has become a victim of its own success, in that once people saw that you could make money by taking this portfolio approach, the game became less about finding those breakthrough technologies and investing in them, bringing them to market, and letting the chips fall where they may on the portfolio outcomes, and more about pursuing the portfolio outcomes and essentially financializing startups and being agnostic to what those startups were building. And that's how you get VC, investing in everything from like sneaker companies to, direct-to-consumer mattress companies, like things that are not exactly technological breakthroughs. And that way of operating over the course of the last 20 years has just really, I think, corrupted the innovation finance system. And we really need to get to a place where we're doing it differently, rethinking growth itself, but also rethinking like what are the models that would help us get to different outcomes where growth in and of itself is not the goal.
Well, you've argued that VC has sort of crowded out some of these more equitable approaches. Tell me, what are the alternatives that you have in mind?
Well, I mean, Mozilla Ventures is actually a really good example. I feel like we're making this one big Mozilla commercial up here, but
I'm good with that.
Yeah, I won't ask you to speak to Mozilla Ventures because I know that's not in your remit. But for those who aren't familiar, Mozilla started a VC fund a few years ago with the idea of investing in solutions for the open web and realizing that there was a business opportunity in a lot of these solutions, but that they were not venture scale, they were not going to be the grand slam returners in the fund. And so it was either very difficult for those companies to raise traditional venture capital, or when they went to try to raise traditional venture capital, they would get sort of corrupted away from that intention by the pressure from the investors to like take the more profit maximizing approach, which often meant, making decisions that got them further and further away from the thing that they were trying to build in the first place. And so, I guess the jury's still out. There isn't enough data from Mozilla Ventures yet to see, but the thesis is we can do it differently. We can make money. We can actually deliver an outsized return by focusing on the vast majority of companies that aren't going to be those grand slam returners and adjusting our fund allocation methodology to align with what the real market opportunities for those companies. And I think there's a lot of inspiration from the way that products get developed within Mozilla that can inform how that investing approach takes place. So that's one example, but there are many other firms who are trying to do it differently. I'm hopeful that we're living in a moment where the macroeconomic context is turning heads of investors to kind of look at doing it a different way, but that might be naive. We'll see.
I mean, I think there's an argument that the venture capital industry peaked already.
Yeah.
I was a VC for many years, and one reason I left is it seemed like the tide was really turning against that the nature of the industry was really changing, so that you had sort of Y Combinator indexing the pre-seed and seed stage market, and then these really gigantic multi-stage funds like Andreessen Horowitz sort of like dominating anything that had the potential to scale. And then
when did you leave VC?
2021.
Okay, so that was peak.
Right at the peak.
VC.
I called the peak on that. And one of the challenges is that
or maybe was it the bottom? I don't know. It depends
on your perspective.
How you look on it. Yeah.
But I think one of the challenges that a lot of my friends who are still in venture capital right now is that if you are sort of in between those two, it's actually incredibly difficult to raise a fund right now. And so the limited partners, which are the giving the capital to the venture capitalists to invest, their expectations around risk profile and return has been really warped over what they've seen in venture in the past 10 or 15 years or so. And so they are essentially gravitating towards, like I said, like these bigger funds which kind of try to like index the market.
Yeah, I mean, this is not much of a debate
at all. This is meant to be a debate, but I want to continue on this track because, Peter, the kind of warping you're seeing, I mean, how does that cash out not just in the financial sector, but actually to the products that people use every day?
Well, I think for a lot of funds, they're actually not making much money. That's sort of the dirty secret about venture right now, is that they're actually the ability to deliver a fund that outperforms basically the S&P 500 is actually very, very difficult, and increasingly rare, I would say. And so for LPs, again, like they're looking for returns that outperform the market, right? And there are a diminishing number of places for them to actually put those. So there's a concentration of venture capital into like fewer and fewer hands, which is creating, I think, a distortionary effect. But it also means that if you are, for people that don't know, like if you have a smaller fund, the expectation is actually that you generate a higher multiple on your return. If you have a multi-billion-dollar fund or $1 billion fund, the expectation is actually like a 1.5x or 2x return is actually like great. And so it's meaning that like the risk profile that investors are willing to take is changing dramatically. That's why you see these big pile-ons, everyone trying to get into the same handful of companies and then raising it at outrageous valuations. It means that things that companies which might have actually delivered a venture scale return 10 or 15 years ago might not be good enough now, I think, to what Catherine's been talking about. So, venture capital has changed. I think the other piece of the puzzle, though, is that like we're not even just talking about venture capital anymore in terms of the capital that's going into these companies. For the most part, the OpenAIs of the world and those sort of top-tier AI companies, they're not really raising from venture funds anymore. They're really raising from either taking money from other big public companies, or from hedge funds and other or sovereign wealth funds and things like that. So the nature of like the industry has changed dramatically.
Yeah, I mean the big funds are, first of all, like, yes, I mean it's literally like exactly what, yeah, I could have said, yeah, underscore everything. And I do think that this this is why I don't understand the logic of most fund managers. And I know it's driven by the limited partners who are investing in the venture capital funds, and like they're the ones who are creating the incentives, and they're the ones who are telling the investors, we're expecting this kind of return from you. And so in many ways, the venture capitalists are just responding to the challenges that have been set for them by their investors. But I still don't understand why there aren't more venture capitalists who recognize, they're not going to outperform the market. They're not going to be Andreessen Horowitz. They're not going to be Sequoia. So why not just try to do it a different way?
I have an answer for that.
Okay, great. I've been on this book tour for like 9 months, and I still don't have an answer.
So for most VCs, they're not really in the business of generating returns. They're in the business of
earning
their
fees,
getting markups.
Yeah,
which then allow them to raise the next fund, which they can take fees from.
Right.
So as long as you can get...
Of course, I know what markups are.
So markups are essentially like the increase in paper wealth on a... So you invest in a startup, early stage, let's say it's a $10 million valuation, you give them $1 million, you own 10% of the company. What your goal is, as an early stage investor, as a seed investor, is to actually get somebody else to invest at a higher valuation, so that the value of your investment on paper has gone up significantly. And then what you do is you take a portfolio of companies that have been marked up, and then you go to raise your next fund, and you go to all these potential limited partners. You're like, hey, on paper, the fund is up, 3x, 4x, 5x. And that's how you raise the second fund, and then you take your fees on that, and then you continue that game. And the idea is that eventually, over time, your fund will have performed well enough that like you'll generate returns. But sometimes you get 2 or 3 funds in before you've generated any returns at all. But because you have these markups, which can go away, you've been a VC for 10 years.
Why does this sound like turning funds into meme coins?
Well,
that's why VCs loved crypto, because it was it kind of took out a lot of the middleman sort of stuff.
Yeah, I mean, the incentives are defining our experience of technology, and this is what Peter's just describing. Are the incentives that investors are responding to are totally not divorced from, totally at odds with good outcomes for users. And I mean, it is actually the theory of enshittification is an economic theory of venture capital. And it can be explained by the way that venture capital itself has evolved over the last 15 years. In some ways, I think maybe the fact that interest rates were 0 for so long was the problem, and that money was just free, so you had way too many. It was just way too easy for somebody to raise a venture capital fund, and then there was so much money in the VC ecosystem, and just too few companies that naturally could deliver those kinds of returns, that it just forced this kind of FOMO pile-on mentality. And that has sort of gotten so calcified because there hasn't needed to be any discipline in the ecosystem for 15 years. Maybe now that it looks like interest rates will be higher for a little bit longer, there's a window of opportunity to say, all right, maybe we should do this a little bit differently. LPs, limited partners, are starting to ask different questions. They're starting to look at maybe, diverting some resources to other asset classes. So maybe there's an opportunity here for somebody like Mozilla Ventures to really create a new market and encourage investment in an asset class of companies that is aligned, whose values are aligned with the values of its users.
I want to pick up on that idea of enshittification, because it feels very sort of connected to some of the things you were talking about earlier, Peter, about some of these maybe trade-offs you make on growth aren't necessarily just about the mission, altruistic reasons, but actually it's just about building better products and having the space to maybe have a longer time horizon when you're thinking about things is conducive to that.
Yeah, I mean, I'll give an example of something that is a big difference between Meta and Mozilla, for example.
Go.
So at Meta, as an employee, your bonus was determined by how much impact you're able to deliver. And so that drove a lot of people to try to find ways that they could show that they moved core metrics for the products that they worked on. So in a weird way, it's not necessarily that there was this top-down mandate to sort of say, I need this specific, and in fact, when I was at Messenger, it was very rarely, I need you to hit this specific number in terms of growth. It was employees themselves were incentivized to find ways to continue to move the metrics in a direction, because that was how they would get promoted. That's how they would get their their bonus, like those sorts of things. And
what were the impact metrics?
It depends on the product, but at Messenger it was a mixture. We had this thing called CDAO, Communication Daily Active User, and so it was a measure of how many users of Messenger would send a message every day. That was basically the core metric. There were some other time spent metrics and engagement metrics and things like that were measured. And so finding ways to move that number was a core mission. And so at the end of the year, or end of each half of the year, when people got their performance reviews, being able to have a list of ways in which you had moved a metric was the surest way to be able to get a higher rating and a bigger bonus. And so the company itself structured its incentives in that way. Now, at Mozilla, we obviously want to incentivize impact, but we don't do it in such a sort of draconian way where it's just about moving these numbers, or that we measure impact in those ways.
Yeah, so what does it look like? I mean, how was that conversation happen at Mozilla? Because I'm actually interested in engagement as an impact metric. Comes from somewhere too, right? It also flows from the logic of venture capital, which is that the stickier it is, the more time on the ads, you can sell more ads, bigger.
Yeah.
And then the enshittification flows from that. Did you as an employee have any sense of how that rolled downhill, how engagement was set? And do you have any sense that if the business model was different, if it was not advertising, would the engagement, how
Oh, at Meta?
Yeah, I mean, this feels like sort of a
that's
naive question.
Yeah, that's a big
die
question.
was cast a long time ago.
Yeah,
Sorry.
I mean, I think that if the business model had been different, I think the metrics would be different, and certainly are different depending on the type of company. So.
Yeah. So at Mozilla, what are what's the equivalent set of incentives that the employees are responding
and so
to?
it's not that we don't care about business impact, but I'll say that we also care about the how, right? And so it's not just about the what; it's also about the how. That's literally specifically in the performance at MoCo. So you can have impact by the way in which you do something, and that can be ways in which you are supporting and making sure and advancing the mission, not just or the ways in which you support the culture of our work, right? And so we do want business impact in the sense that we are it is a business and we do need it to be successful because that's how we again support the wider broader mission of Mozilla. But we always have it within the framework of the mission, and we do really care about the ways in which people work and the way in which you're doing that work. Because if somebody had outsized business impact, but they compromised our values, that would be a problem. That's not something that we would reward. And I think that's different. That would be different at Meta, to be honest.
It seems like, I mean, Catherine, you were talking about power law being, a good thing to emerge naturally from a fund maybe, but a bad thing to just optimize for. Same thing applies to engagement or just growth as a metric. It feels like we keep coming back to this idea of once something becomes the measure of success, it's no longer a good measure of success. So how do you go beyond that but still have some kind of KPIs to whatever you're doing?
I mean, at the end of the day, the culture and the values, the decisions that people are going to make, when it's not something that is just guided top down, I think ultimately that's what matters. And you have an organization of people that really care a lot about what they're building and who they're building it for and why they're building it. And so again, there are all sorts of corners that we could cut, with the products that we build. Certainly with Firefox, we could make more money through advertising if we started tracking people and having, capturing and data to better personalize ads and things like that. We leave that money on the table because it doesn't align with the values of the organization. And that's something that we communicate, comes obviously top down, right, from leadership, but we also communicate it to each other. And so when we're having conversations about what we want to do, when we're having those internal debates about what the lines are, what's appropriate, what's not appropriate, it is really valuable to have this internal culture where people understand there are some things that are non-negotiable, right? And it's okay to have conversations about it. It's okay to sort of figure out what's the line, what's appropriate, because technology evolves, right? Cultures evolve. What we might care the most about in 2025 might be different than it was in 2010 or 2005. It's okay to have those discussions. But one of the things that I love about working here is that the conversation is never growth at all costs. That moving the metric is more important than our values, right? And I think that is something that is just different than the big tech companies, where the pressure to move those numbers, to constantly drive things forward, means that when you have to make a decision between maybe doing the right thing for society, so to speak, and the right thing for driving profit or moving the stock price or something like that, I'd say probably 9 times out of 10 the decision is let's do the thing that's going to move this, move the metric.
I think this is a really important thing for people who care about protecting what we all love about the internet to understand. And I speak for myself. The reason I wrote World Eaters is because I was working on how do we make technology better for people, and realizing at some point that you have to follow everybody's responding to some set of incentives, and those incentives are defined by the economic structure in which the technology is built. And if we don't understand that, we're never going to actually be able to solve the problem of the internet getting worse for people. And that's why I think it's really important for all of us who care about an open web or technology that is working, in the public interest, to really care about these super tedious and boring things that, we don't want to focus on governance structures and, financing systems and all of these things, but it's super important. It is driving every product decision you see is driven by what's the financial incentive structure behind the company, the founder, the value set, and how do you create financial structures that allow space for values-based decisions to come into the equation?
Yeah, it's definitely one of the things I'm taking away from this conversation. I think, as a reporter, you often just focus on here's the thing that the person did, and you're explaining that. But Peter, whether you're looking at the bonus structure within an organization or whether it's the financial structure, Catherine, surrounding an entire industry, that seems to be this almost invisible force that's missed. So I'd love to know how you unlearn that and kind of actually begin to see that. Tell me a little bit more about what led you to write your book.
Yeah, so I guess one other thing just to say is that, and I hope this is an audience of people who really does love technology in the way that I do, and I think, where we land on policy, okay, what do we do about it? If our analysis of the problem is that it's the technology that is the problem, it's the advertising platform or the whatever, then we do end up risking the thing we love about the technology or over-regulating it, and that is a risk. And I think the conversation around Section 230 is really germane here. Like, I think when you analyze the problem as being about social media as a platform. Oh, sorry. Everybody at MozFest knows what Section 230 is, right? You know, the Communications Decency Act that removes accountability for platforms about the content that's posted on the platform. You know, that opened up a lot of space for a robust, diverse, really vibrant internet to emerge, right? In a way that, if it didn't exist, probably would have been a lot more locked down and constrained in its early days. If we're focusing on what went wrong on the internet and saying, okay, well, it's the technology that's the problem, so we have to lock it down in this particular, we have to lock the technology down in these particular ways, we wind up killing the thing that is good about the technology while we're trying to protect it. Instead of focusing on, the system that created the thing, like the technology itself is valueless, but it came out of a system that determined its value. And so we're not focusing on that piece of it. I think that's just like something that's really important to keep in mind for those of us who care about, what are the policy solutions to fix what's broken about technology these days. But to your question, what was that,
how did you move beyond just seeing sort of, technology is leading to an outcome I don't like in the world, to actually really think more about the incentive structures?
Well, I mean, I think it's taken me an embarrassingly long time. I would say, I've been working on tech policy for 20 years at this point, and maybe 5 years or so ago, it did occur to me in the course of talking about actually how you protect gig workers, that we were talking about companies who never had the space or time to take these things into consideration, and that on a Tuesday it felt like they were these startups that maybe wouldn't even exist in 3 months, and so it was totally unrealistic to ask them to have all these frameworks about taking care of drivers and all of that. But then, by the end of the week, they were multinational corporations that were too big to fail, and it just happened so quickly. And that got me thinking about how do they grow this fast? Why is the trajectory so up and to the right? Is that unique? And that sort of cascaded into asking all of these additional questions and ultimately landing on, venture capital, that's the thing that's actually driving all of this.
One of the things that we've all kind of tiptoed around a little bit in this conversation is OpenAI, the most valuable private company in the world right now, at least on paper.
Get that markup, right?
You mentioned some of the debates over the recent restructure, Catherine. Could you just kind of quickly explain what's going on with OpenAI's structure, how they were founded in 2015?
Yeah, I'm going to try to do this without clearing the room or putting everybody to sleep.
Sure.
Okay.
The high-level overview.
Yeah, I think going back to this conversation about Mozilla's structure, where the nonprofit owns the for-profit, and the purpose of the for-profit is to generate revenues to return to the nonprofit so the nonprofit can fulfill its mission. In theory, that's what OpenAI was structured to do.
You spoke to Sam for your book, right?
I did, yeah.
Sam Altman.
OpenAI was founded as a nonprofit. They raised a bunch of money and then realized it wasn't going to be enough money to actually build the thing they wanted to build, that they would have to figure out a way to raise private capital, and they settled on this structure of a for-profit company that was owned by the nonprofit. But then they made a choice to sell sort of basically equity stakes in the for-profit. Then there was a seminal moment where, and I talked to Sam before he got fired, but of course, I'm sure everybody knows when he got fired and then rehired, and then the nonprofit board that fired him was dissolved.
Changed in composition.
Yeah, pretty much dissolved because they exerted their authority. The nonprofit was exerting its priority of advancing the mission and not profit. And investors actually really drove that. Investors and other shareholders in the form of employees drove that decision. And so at that point, it became pretty clear that what OpenAI was responding to was a profit motivation and not the nonprofit mission. So when they decided they were going to like make that official essentially and restructure and spin the for-profit out from the nonprofit, we started this whole campaign to protect the nonprofit's assets essentially. And long story short, now we have forced them to retain the ownership structure, and we're hopeful that hopeful-ish. That we will be able to enforce the terms of that agreement, and that there's some way to keep the nonprofit in control of the for-profit. But really, practically how they are acting in the marketplace is as a for-profit company. That's no different from Google or Meta or any of the other for-profit companies.
Do you worry, Peter, that if let's take that at face value, OpenAI is acting like a for-profit company, it just makes people skeptical of any attempt to kind of insulate one's organization from market pressures the way Mozilla has?
OpenAI feels like an outlier in so many ways that I'm not especially concerned about it. I do think that, I think as you noted at the beginning of the conversation, we are building products that compete in the same market as things made by for-profit companies, and I think just reminding people that we're backed by a nonprofit doesn't necessarily guide a decision one way or the other as much as we would like. So I would say it's less skepticism, and I think it's more of a you still have to create value, so to speak, for your users, right? You still have to demonstrate to them that the products you're making are worth using. But I think that, to kind of zoom out a little bit, I think that, Mozilla can't do all this alone, so to speak. Like, we want there to be more, businesses that look like us out there, that are mission-driven, that are backed by nonprofits, that are, really supporting the values of an open internet, and one which is everyone has a chance to participate in and shape. But also, and I'm not a policy person, but I do think that as societies, that if there are things that we believe are public goods that we think that need to exist, we should not be afraid to introduce, regulation to help that. And certainly Europe, I think, has been at the forefront of trying to break some of the monopoly power that big tech companies have, and giving consumers more choice, more agency over how they're able to use whether it's their smartphone or other devices, and we think that's really important. So, you have to really take a broader perspective and think about how, it's not just about one thing, as Catherine was noting. It's not just about one little piece of how a business operates. There's an overarching set of incentive structures that flow down from, just being in a capitalist society all the way down to, the bonus system that a specific company might have, and a set of regulations that we all operate in. And so, while we, are building with our mission, and we're really focused on trying to build things that, make the internet a healthier, better, more sustainable place, we can't do it alone. And that it's going to require all of us to really get engaged and ask for smarter public policy, right? Smarter regulation, but also to demand more of the for-profit businesses to, make decisions about what we use and what we don't use if it doesn't align in our values. And I think it's tough, and it's hard to be a purist, right? I think that all of us use products that we don't necessarily love the values of the company that make them. But it's impossible, I think, unless you completely go off the grid, right? To avoid, you may use an app and you don't realize, well, you know what? Like, I love that app. I love the company's values. Well, it turns out maybe they're using AWS, like Amazon, and you don't support Amazon. So it's can be very, very difficult given how entangled everything is. And so,
and just how centralized
things are, right?
Right
exactly.
now, and it feels like, AI and the scale of compute required is just intensifying that concentration in so many ways. I could pepper you both with questions all afternoon.
Yeah, we're getting the...
But we're going to throw it over to you all. So I think we've got 2 microphones there in the middle. Someone will correct me if that's not the case.
I see one.
I see two.
Oh, there's
Oh,
right
yeah, too.
So yeah, fire away. Maybe y'all can get Peter and Catherine to debate each other more than I was able to.
I mean, while people are making their way to the microphone, I think, what you said made me think that, like, the other kind of consequence of the venture capital logic having, grown, metastasized in the way that it has, is now it is corrupting our political system as well, because the logic of venture capital requires that there be no regulation, that they not be helped, right? And so now there's so much money at stake that to make any of those choices in a democratic way, it becomes an existential threat. And so I think for any of us that care about the future of democracy, I think it's really important for us to understand the logic of VC as well and how it is starting to impact our political system.
Go ahead.
Yes.
One question basically about the venture fund and maybe the KPIs that are being used in impact investment, right? Typically, I haven't yet seen any venture capital system that would look at anything else other than the KPI of money. Mm-hmm. And have you seen any system or strategy or something that has been implemented already that looks at other KPIs that would actually drive the decision even to pull out of an investment of, okay, you reached the money KPI, but you didn't reach the other KPI, the impact KPI that you wanted to improve, so we're not going to continue to fund you because we have proof that you don't align with that mission in some way. I know it's difficult because there's so many different social, environmental type of impacts you can have. That's why I'm trying to ask, have you seen anything that has been implemented that worked really well already?
Well, I mean, I get triggered a little bit when the thing that comes to people's mind when I say we should look at a way of investing that is not venture capital, and they say, oh, impact investing. Because the implication there is that you do have to leave money on the table in order to build products that are good for people. And I don't think that's actually true. And I think impact investing has its own set of challenges. I have another critique of ESG that I'm happy to talk about if we have time. But what I'm suggesting is that, as Peter said, most venture capital funds do not actually perform that well because they're chasing a very small number of companies that could actually create the returns that they expect. And so what fund managers should do is face reality, recognize that the vast majority of companies that get started have a market opportunity. It's just much smaller than what OpenAI or Stripe or whatever is going to be, and then design the fund methodology in a way that aligns the values or the market opportunity of the company with the financial returns of the fund, so that when the fund makes money when these companies organically achieve the market opportunity that they're setting out to achieve. So it doesn't even need to be, there's no impact goal specifically. It's a $500 million company instead of a $500 billion company, and let's be honest about that and set up the fund to take advantage of that kind of company. And in the book, I write about all these examples of companies that were exactly that and made money for investors when they actually, offered them that opportunity and offered them money in a way that aligned the financial outcome with the real market opportunity of the company. And actually, at the end of the day, as a natural outgrowth of just pursuing the real market opportunity, they mitigated harms for sure, but also achieved some societal benefits, like the funds turn out to be more diverse and the types of problems that they're solving turn out to be problems that we actually need solved in society, like the housing crisis. So I think if we just did the simple thing of aligning the actual market opportunity of companies with the fund methodology and sort of thought different, we can do something other than just power law distributions, then maybe we would come up with something that does look better for society naturally.
Though it's funny because I've raised over $100 million in venture capital as a LP. From capital from LPs.
Yeah.
As a VC.
Yeah. Tell me why I'm wrong now.
It's not that you're wrong, but what it is that first of all, raising a venture fund is incredibly difficult. for most, most general partners, was including for myself. And one of the challenges is that LPs, they often want to see that you were in hot companies.
100%.
Like, that's what they want.
LPs are the problem.
Yeah, LPs are the problem, right? And so you can sort of say, hey, I have this strategy, and not even it's going to have a worse return profile, but you might not. But that I didn't get into Uber
FOMO,
or that sort of thing. And so that's how they validate you as an investor, is that you had access to the hottest deals of
It's like a proxy, a
yeah,
simplifier
and
for how
it's
cool
really
you are.
frustrating. But again, LPs, they can be just as human as all of us, right? And so,
Right.
Just in the same way that you need some proxy in which to assess somebody that you don't know very well.
Yeah.
Being able to say, like, look, I was the first investor in Hugging Face, right? And I will dine out on that for a long time.
Yeah.
And because when I tell people that in the Valley, like, it gives me cred, right?
Yeah.
But all the other smaller companies, which were not as successful, but are still maybe even more sustainable than Hugging Face,
right.
honestly. You don't get the social status of that, and it doesn't. It wouldn't help me raise another fund if that's what I wanted to do.
If anybody wants to understand all of these dynamics more, definitely buy my book. Or actually, they're giving it away for free.
I think we have a few copies floating around. Right, we're going to throw it over to another question. Go ahead, sir.
Yeah. No, thanks for the discussion, really insightful. Now, just flowing into the previous conversation, a lot of the issues that we were discussing boils down to the abundance of capital or the abundance of risk capital in a very limited geography, in this case, the Valley, Silicon Valley. Peter, you alluded that in the last few years, you are seeing that a lot of VCs are not really able to beat the index even. Mm-hmm. Are you seeing, so you or Catherine or anybody, are you seeing any signs of some of that capital coming from LPs or elsewhere getting diversified to other geographies, to other sectors, or is it still limited to that particular area, that risk capital?
I mean, I can share what I've seen, which is that a handful of funds are getting much bigger, and they're absorbing the capital that would have gone to other funds. And so it's very quiet, but a lot of funds are not continuing on. Firms are not continuing on. They're not raising an additional fund. Some are merging. But what's happening is that the biggest funds like Andreessen Horowitz and General Catalyst and a handful of others are just raising so much money that it's essentially sucking up all of the excess capital that would have gone to dozens or even hundreds of other funds.
Okay, thank you. Thank you.
There's one right here.
Hi, small confession from me. I'm actually a venture capitalist. Was hoping to fly under the radar. I think there's one particular question, and maybe one of the tensions that you picked up on is particularly around the limited partners investing into firms, and quite a large proportion of the mega funds that are deemed to be top tier VCs but are actually creating loads of harm on people and planet, receiving the largest allocation of limited partner money. My sort of question now is in terms of also looking at the pension reforms that are ongoing in many, many different countries, particularly also in my case in the UK. There's a bit of political power, particularly as someone paying into a pension, that you could influence the sort of trajectory of where that money is going to be allocated. So where do you see the potential for more civic action in actually changing the structures for equity distribution in the VC model that actually drives innovation as it did maybe 15, 20 years ago? Or maybe even in the sense of actually driving better outcomes for people and planet?
Yeah. I mean, some pension funds are starting to come around on this. I mean, there's just a real challenge in, really it's a principal agent problem where the people who are making the investment decisions are not actually the people whose money it is. And so there ends up being this chain of accountability that, by the time it gets back to, in this case, like the labor unions who might represent the pension holders who are like, wait a minute, we're investing in all these companies that are actually like exploiting the workers that are our members. then like it's now, I think we're at that stage, and now these workers or unions are starting to ask themselves questions about like, okay, so what do we do now? What's the right strategy? And I think it's a kind of a tough nut to crack, because you still need these funds to make money so that you can deliver these pensions. And it's very hard to ask them to be the ones who are the limited partners who take the first step into this new regime. But like my argument to them is, you're not all going to be in Sequoia and Andreessen Horowitz, and increasingly that's where all of the VC returns are going to be. So why not like start to experiment a little bit with staking out this new ground? It doesn't require you to get out of those funds or divest from venture capital. Maybe just start to reallocate in new funds into this different way, and that's like gaining some traction. But again, that's why it's really important that people understand the logic of VC and how it flows downhill. I think there's still a lot of people who are working on the issues on the ground who are blind to that and have not seen how this, the problem that they're working on, in this case maybe like worker exploitation and harms, is actually driven by this upstream system.
Yeah, I mean, I'd also love to see university endowments getting pressure from students and alumni around what they're investing in. In my experience, having raised a handful of funds, pension funds and university endowments were the most conservative in terms of like wanting to just go with like big established names that they already knew and giving LP funds. And so, and of course, like, the people that manage those funds are fiduciaries, and they have to, their job is to, as you mentioned, generate a return, whether it's for a university or for the pension funds, for the workers that rely on that, retirees, I guess, who rely on that. But I'm surprised at sometimes how little activism there is, especially for the university endowments, because I think a lot of students would be very surprised at what those universities are investing in.
We have time for maybe one more question.
Hello. Yeah. I have so at the beginning of the talk, you mentioned how in Mozilla you need to sort of balance this tension between staying competitive in the market and pursuing your values, and growth that doesn't, this is what rang in my head, growth that doesn't ensure that the growth doesn't affect, eco-friendly movements or whatever.
Yeah.
So to a particular thing that I just saw in Mozilla recently, the AI tab, I don't know, a lot of talk about where these data centers are being built, how this is one of the few situations or sectors where like consumption of electricity is rising dramatically. In this very particular case, if you could maybe, I don't know, talk us through how this tension between, should we incentivize these perhaps unsustainable technologies, or should we maybe become non-competitive, or should we incorporate them?
Yeah. And so I'll have the disclaimer that I don't run Firefox or work on Firefox specifically, and so I don't necessarily have a lot of specific insight into the decision, but I know what you're referring to. And so at a high level, when it's come to AI, the general principle has been we want to give users choice and agency over how to integrate or not integrate AI into their usage of the product, just in the same way that we give users agency and choice over whether ads are experienced in the product at all. And so, AI is, first of all, I don't think it's going to go away. I think that it's going to be something that's with us. Because there is at least some user demand and interest for the product, the decisions with how AI has been integrated, at least so far, has largely been how can we give them the choice or option to be able to use it within Firefox in a way that that they're comfortable with. And so, just in the same way that, let me give you an example. Do you think that we should block users from going to chatgpt.com? I'm sorry, I can't hear your answer, but
you could argue.
Okay, sure, but the point is like
there goes the open internet.
But we don't make any decisions like that, with the browser, right? Like we don't make any decisions about what you can view or what you don't view with Firefox. But we do give you the option to open a side tab and to pick a model of your choice You can point it to a local model that's completely private and you have complete control over. You can log into an account if you have it. But we give the user the choice. And I think that aligns with the values that we have here. I appreciate the question, though. It's a good one, and I think that it's a debate that we have and continues to be ongoing about how we integrate AI into the product. But the one thing we will never compromise is that we will always give users the choice of how much or whether to integrate any AI into their experience with Firefox.
Unfortunately, that's all we have time for. I've got a timer on these screens like a ticking time bomb. But thank you all for spending your Saturday afternoon, evening, talking about incentive structures and unlearning growth with us. Questions have been fantastic. Can I ask one more favor? Please give it up for Peter Rojas and Catherine Bracey.
Thank you.
Great, we go off it the same way, this way or this way?
Harry, Catherine, and Peter, thank you all three of you. Can we give them one more round of applause, and to Harry, our moderator. Thank you so much. So this concludes our debates for today, but we'd like to see you all back here at 6:30. We're going to have one more debate on unlearning regulation. Take a little bit of time, enjoy the afternoon, and we will see you back at 6:30. Take care.